Right. So, we've learned about the criteria that have to be satisfied in order to recognize revenues in the income statement. And we also know why financial authorities have come up with these rigid rules. Revenue reporting plays a critical role and impacts the decision-making of both internal and external stakeholders. In this lesson, we'll talk about the recognition of expenses. As you can imagine, similar to what we saw for revenues, there is a set of rules that regulates the correct period in which expenses should be recorded. Financial authorities cannot allow companies to manage this process on their own without supervision, because this will create the temptation to manage the recording of expenses in periods that are more favorable to the company's management. For example, a manufacturing company could be tempted to register the cost of the raw materials it uses in January 2017 rather than in December 2016. This will have a direct impact on the profitability of the company in both 2016 and 2017. The company will be able to report higher profitability margins and thus will appear more attractive to investors. In order to impede such behavior, financial authorities apply the matching principle whenever possible. The matching principle is an important accounting concept, stating that expenses incurred to generate revenue are recognized in the same period as the revenue. So, according to the matching principle, if the manufacturing company makes sales in December 2016, it will have to record the cost of raw materials in the same period. However, we should always remember that not all of a company's expenses can be tied to revenues. These are the so-called period costs. Examples of period costs that a firm can have are administrative costs and utility bills. These are expensed in the period when they are incurred. In our next lesson, we will look at long-lived assets and how they are depreciated and amortized.